Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news that could guide the market. Let's get right on with this main topic and what could be one of the most important investing videos you watch, because I know half of you think I must have lost my mind if I'm going to say something bad about Nvidia. I mean, look at that chart. How could you not invest in something like that? Okay, hold up there. I always get waves of comments and emails whenever I present the bear case of one of the hot stocks at the moment. Okay, investors seem to think that just talking about the downside risk is going to cause it to go down, or it's just outright blasphemy. As if we should all just keep talking up the stocks, bring in more investors, and everyone gets rich and happy together. Sorry, folks, the market just does not work that way. Nation, in 20 years investing, and more than half of that as a professional analyst in venture capital, private wealth management, the most important lesson I've learned is to question the market and question even my own perspective. Okay, when it is so easy to only pay attention to the news that supports your view on a stock, you have to make that conscious effort to look for, to find those counter arguments and the analysis. When well reasoned and deep analysis of a stock says something you don't like, that doesn't automatically make it wrong. I'm going to point out some of that analysis on Nvidia, with 3 reasons why it could be in trouble from here. Stick around after that. I'll show you the stocks I'm watching this week and the economic news you need to see. Before that, I do want to point out a special offer from Seeking Alpha. It's one of the few resources I use every week, this premium access, and I just got a promo code for the premium access. Use the link I'll leave in the description below. You're going to get a 7-day free trial to check it out, plus a $50 discount if you decide to use it. The free analysis on Seeking Alpha is sometimes hit or miss, but you'll always find quality analysis in the premium access content. I use it to find the other side of the story, plus some of the best screeners online. So check that out. Again, with the link below in the description, you're going to get a 7-day free trial, no obligation to try it out. If you like it, you're going to get that $50 off the membership price. But let's get back to that main topic though, because this is something you're not going to hear on most of those YouTube channels, just pumping one side of the story. Yes, Nvidia is the undisputed leader in semiconductors right now, especially those capable of doing that intense processing required for AI software. Forrester Research, in fact, estimates that the company designs anywhere from 80 to 95% of the AI chips in use right now. But when you're sitting at the peak of Mount Everest, there is nowhere left to go but down. But while that mountain of demand for AI chips will get higher, can shares of Nvidia continue to produce those market beating returns with the valuation already at 21 times this year's sales, especially when competitors are aiming exclusively at the heavyweight? Intel's Gaudi line of chips helped its stock rally when second quarter earnings were reported, with CEO Gelsinger noting that its pipeline opportunities for the chip are now over $1 billion. For its part, AMD's M1300A is a strong contender in that combined CPU GPU format, though the fact that the company didn't announce any major customers in its June rollout leads me to believe that adoption is a little slow here. Even NVIDIA's major customers, though, may soon be competition. Microsoft, Alphabet, Amazon, and Meta all announced projects to design their own chips just to limit that reliance on NVIDIA and produce semiconductors specific to their own needs. And against NVIDIA's dominance and a 21 times sales valuation, rivals are a steal at these valuations. Here we see on the statistics tab on Yahoo Finance, NVIDIA Corporation. We can scroll down here and it says 37 times its trailing sales there. I'm using 21 times sales valuation for this year's expected sales, but we'll use the trailing number as well here. 37 times trailing sales. Now you can see it was down as low as 11.5 just last year. So right now, extremely expensive, not quite as expensive as it was there in July. Sales have come up this year, almost double from last year's sales. So the sales valuation, price to sales valuation has come down a little bit, 37 times. That is still extremely expensive, especially against the market valuation of some of its competitors and just the marginal market share they would have to take to really take these shares off. Here we have Advanced Micro Devices designing very good chips, price to sales of just 8 times price to sales. And then there's Intel Corporation, priced at just 2.8 times the trailing sales it's booked over the last year. And what I want you to understand here, folks, part of this argument is it's not going to take a threat to NVIDIA's dominance in AI chips. NVIDIA will always be dominant in those chips, that processing power needed. What I'm saying here is that the valuations and the risk reward just don't line up. Okay, at a valuation of just 8 times price to sales, AMD just needs a fractional more share of that market to really take these shares off and produce a better return than Nvidia. What I'm saying is that Nvidia, yes, it is still going to dominate the market for AI chips, but are you an investor and are you looking for that better return that you're going to get in its competitors? Think about it this way. Even in 2019, so before the pandemic, when tech shares and Nvidia were touching those all-time highs, shares of the company traded at an average of just 15 times sales. Here we are on Morningstar. We can see a little bit longer term valuations for price to sales, price to earnings, all those great valuation signs that we look for. And here in 2019, you can see it was trading at an average of 14.5 times on a price to sales basis. That is 28% lower than the stock is trading on this year's expected sales and about half of where it's trading on trailing sales. Just some back of the envelope math, folks. At this rate, Nvidia could meet next year's sales target of $81 billion. It would be another year of meteoric 49% growth after doubling its sales this year. Its valuation would just then get to that 15x historical average. So just catch up with the long term historical price to sales average. And that is if the stock has stayed where it is right now. No returns from here for another year. I think the market is already catching up to that idea. If you look at the price action in Nvidia just over the last week, you see here in Nvidia in green against the S&P 500, there in pink. Nvidia actually underperforming the S&P on an up week. Usually these up weeks, you see those growth names like Nvidia, like other chip stocks rising. You saw that with the other chip stocks. You saw that with AMD up 7.6% last week. You saw that with even Intel. Intel, the dog Intel, was up 12.4% last week, while Nvidia underperformed all those and the major index. So you've got the competitors coming for Nvidia's market share. The biggest threat to Nvidia, though, may not even be its competitors, but simply slowing demand. Okay, data centers and those hyperscale users like Meta, Amazon, Google, they're investing in that chip infrastructure, the brains, the semiconductors needed to run that AI software to the tune of $55 billion in Nvidia revenue alone this year. Okay, that's double last year's sales. You just don't need to do that every year. Once you have that infrastructure set up, you only need to replace it every few years when those new better chips come out. We could see a slowdown in chip demand over the next year or two. That is going to severely weigh on investor sentiment and sales for Nvidia. Again, nation, don't just take this from one person here on YouTube, even if they do rock a bow tie. Okay, look for your own research. Look for the other arguments to it. And I think you're going to find investors have one of two options here. One is to diversify into competitors like AMD or Intel. Okay, AMD is a very well-run company with a strong line of chips, a valuation less than a third of that of Nvidia. Again, we're not talking about whether the Nvidia is going to lose its dominance in AI chips. We're talking about who is going to produce the better returns. Okay, you will not get a 10x return from shares of Nvidia. It would have to be a $10 trillion company at this point to produce that 10x return. Okay, that would mean it would be larger than Amazon, Apple, and Microsoft combined and still have like $3 trillion in market cap above all those three combined. You are not going to get that kind of return out of Nvidia. I'm saying, look at some of these competitors, AMD, Intel, some of the other designers to get that higher return, even if Nvidia keeps its lead in the AI chip market. Now, that said, I'm still not totally convinced Intel can pull off its dual goals of becoming a chip designer and foundry business. So remember, a lot of chip companies, they only design the chips. Nvidia, it only designs its chips. It then has Taiwan Semiconductor manufacture its chips, that foundry business. A lot of chip companies are like that. It is extremely expensive to develop and design these chips. They don't want to have to pay the capital intensive production necessary to manufacture them as well. What Intel is trying to do, it's trying to do both of them at once. Okay, it is trying to reinvigorate its chip design business. It used to be the number one leader in chip design. It fell off that perch many years ago and has struggled to get back anywhere close to there. But now it's also trying to become a manufacturer. So now it's trying to compete with Nvidia, AMD as a chip designer and compete with Taiwan Semiconductor as a chip manufacturer. I don't think it's got the capital it needs to do both of those at the same time. And I think CEO Gelsinger is just going to be spinning his tires trying to go after both of those goals. It may be too much to consider. So I would look at AMD instead. Now, option two here. Well, the other thing investors could do for those higher returns is something I've been talking about over the last few weeks. All the market attention right now is in those AI chips, is in semiconductors, the infrastructure, the brain infrastructure needed to process that AI software eventually. Eventually, though, the market, investors, business will move on from that. You only need to set up that infrastructure and renew it every few years. Okay. Eventually, the market will get saturated with these AI chips. It's going to move on to cloud services. It's going to move on to AI software. So you want to start looking at those software and cloud names now to get in front of that. You're going to look at cloud names like CRM, Salesforce. Even Amazon, cloud name. You want to look at those AI software companies like Path, like UiPath, like Unity Software, like Palantir, even, among others. But again, that's just my perspective on NVIDIA. Let me know what you think in the comments. Feel free to hate and troll all you want there in the comments. I want to talk about the stocks I'm watching this week now. First up, Zscaler, ticker ZS. It's going to be reporting its earnings on Tuesday with expectations for the cybersecurity company to double earnings on 35% sales growth from last year. Now you can see in the chart here, the shares already bounced last week on a positive earnings call from CrowdStrike, with both stocks up 12% on the week. That's recovering a lot of what they lost after Fortinet's weak earnings the week before. Zscaler is one of the most expensive cybersecurity stocks here, though, with a 15.4 times price to sales ratio. Also one of the fastest growing, with 46% sales growth expected just this year. Now, the group has been especially volatile lately, and ZS seems a little pricey here. I do like the stock, but earnings could be a letdown. I would be picking up the shares on any drop, but I wanted to wait for a little bit better price valuation in this one. C3.ai, ticker AI, is also going to test investors' enthusiasm for those AI stocks when it's going to report its earnings on Wednesday. The shares are down 32% from the rally in June. You see that here in this graph here. And while sales growth of 15% expected this year is good, it's kind of low compared to some of those other AI stocks in that theme. That said, the company is expected to reach profitability next year and could a surprise announcement by management that could move forward that consensus a little bit could boost the shares. So even with those high expectations, if management says, hey, we're getting some strong demand for our AI software, that's going to move us up into profitability earlier than expected. I think that could be the catalyst that investors need to push these shares up a little bit more. ChargePoint Holdings, ticker CHPT. It's going to also report its earnings on Wednesday with the stock off 45% from its January rally there. The stock is trading on the idea that the company is going to need to issue more shares for funding it, as it has just $300 million in balance sheet cash. And those higher interest rates lately have made debt just all too expensive. We could see a short drop on any share announcements, which I believe we will get. Okay, this company is going to need to issue new shares, build up that funding base to be able to survive. But I would add to my position at this point. I do own shares of ChargePoint. Revenue is expected to surge 44% this year and 54% next year, as that charging infrastructure is really still the only sorely behind that growth in EV sales. Okay, EV electric vehicle sales taking off over this year and last, but that infrastructure is still not in place to charge those cars. Government programs still favor that charging build out, and shares trade for an attractive 3.9 times price to sales on this one. Zooming out to the bigger picture here, we see on the sectorspiders.com, the sector tracker, great free resource here. We see over the last week, 9 of the 11 stock sectors did close higher last weekend, and the to be expected strength in those growth stocks like technology, like consumer discretionary. Normally, when the market rises, you would see these sectors or stocks in these sectors rise because they're a little bit more risk, a little bit higher beta names. Investors continue to sell safety stocks, though. Utilities now down 17% over the last year. Consumer staples also down last week. If the consumer does weaken into the fourth quarter, though, revenue in these necessity sectors, okay, these sectors like utilities, like consumer staples that sell things you have to buy, they should hold up fairly well and bring investor sentiment back to support those prices. What I'm talking about, folks, is if we zoom out to the year to date, the 2023 picture, while we would expect stocks in the consumer discretionary sector to do well in that rebounding market, like we saw last week, the strength in this sector is just a little surprising, given some of the warnings of a weakening consumer by major retailers. Okay, retailers all the way from Foot Locker to Nike to Macy's all warned on those lower third quarter earnings and pointed to a noticeable turn in consumers. Friday's jobs report confirmed a slowdown in the employment picture. We saw just 150,000 jobs added over the entire summer there. Considerable weakening in the employment picture, higher jobless numbers, and the restart to those student loan payments in October is just going to hold a pall over the holiday shopping season. Against this, of course, we see consumer discretionary sectors outperforming the broader market in every time period from 1 month all the way up to 1 year. Is underperforming in that 1 year picture, but the 1 month here we see in the year to date 31% higher for consumer discretionary stocks, almost double what the S&P 500 index has done. Now, more warnings on sales are likely to come from stocks in this sector, and investors should be cautious at that point on any stocks in this consumer discretionary sector. Get your 7-day free trial to check out Seeking Alpha Premium Access and the promo code for $50 off with the link below in the description. or click on the video to the right for the 5 stocks to buy that could rocket next. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.